Look at the top-line numbers, and the United States appears to be operating at peak performance. It has the world's largest economy, powerful corporations, and the strongest currency on the globe. But beneath that outward success, a massive financial weight is steadily compounding. Two distinct forces are currently grinding against each other. On one side, the national debt is expanding to historic highs. On the other, everyday living costs remain stubbornly elevated. Which brings us to the defining question for 2026. Is it mathematically possible to sustain aggressive economic growth while carrying this much leverage? The true measure of economic stability going forward will no longer be how much the economy produces, but how efficiently it manages what it owes. The federal government relies on continuous borrowing to function. It issues debt to fund everything from defense spending and highway infrastructure to daily operations and healthcare programs. For years, this system operated smoothly because interest rates hovered near zero. Capital was effectively free. That era is over, and borrowing has become highly expensive. This chart breaks down the total federal budget. Notice the interest payment segment. As rates stay high, the sheer cost of servicing the existing national debt is rapidly expanding, squeezing out the rest of the budget. Every additional dollar spent on interest is a dollar taken away from vital national priorities. As the cost to carry the debt inflates, resources for future investments simply shrink. The massive debt accumulating in Washington functions as a systemic pressure cooker, eventually venting its fiscal weight directly onto the American public. Ordinary citizens don't interact with the national debt directly. They experience the fallout at the grocery checkout, at the gas pump, and in their monthly rent checks. We can see why this happens on this graph. When official reports state that inflation is dropping, it only means prices are rising more slowly. The actual cost index, the price tag on food and housing, remains flatlined at an elevated level. These prices are sticky. For the typical household, generating income is no longer the primary hurdle. The real challenge is keeping any of that paycheck after covering basic, non-negotiable living expenses. This creates a severe psychological disconnect. Government data paints a picture of a healthy, recovering economy, while consumers feel a continuous drain on their purchasing power. At the household level, unmanaged national debt doesn't manifest as a sudden market crash. It shows up as a quiet, permanent reduction in the everyday standard of living. The tension in this economic machine is controlled by a single institution, the Federal Reserve. The central bank faces a brutal mathematical dilemma. Policymakers must hold interest rates high enough to choke off consumer inflation, but stop just short of triggering a nationwide recession. Those exact same high rates are actively making the government's problem worse. Every time the Treasury rolls over old debt, it must do so at these new, elevated interest rates, heavily increasing the national burden. That high cost of capital ripples through the entire system. It freezes out homebuyers facing expensive mortgages and stifles small businesses trying to secure loans for expansion. Interest rates are a blunt instrument. The very medicine required to cure consumer inflation is simultaneously aggravating the government's debt crisis. The corporate sector is facing a similar reckoning. For over a decade, businesses relied on cheap capital to easily fund their growth. That safety net is gone. The mandate for 2026 is simple. Companies must figure out how to do more with less. Survival depends on maximizing internal efficiency rather than pursuing expansion heavily backed by debt. This severe borrowing squeeze is acting as a catalyst. Corporations are rapidly accelerating their adoption of artificial intelligence, specifically to drive down operational costs. The future corporate landscape is actively dividing in two. The companies successfully implementing automation will maintain their margins, while those that fail to adapt will buckle under the weight of high interest rates. Sweeping technological leaps like artificial intelligence have transformed into essential survival mechanisms, forced into the mainstream by these mounting macroeconomic pressures. Looking at this mounting debt, the immediate public fear is obvious. People want to know if a full-scale sovereign financial crisis is imminent. The reality is more nuanced. The United States has massive structural safeguards. The enduring global dominance of the dollar and the unmatched scale of the American financial system provide a buffer that most nations simply do not have. The true danger is long-term. If deficit spending continually outpaces the growth of the broader economy, those unique global advantages will eventually erode. A sudden overnight collapse is highly unlikely, but without structural changes to spending, a slow, painful period of economic stagnation becomes virtually guaranteed. Institutional investors aren't waiting to see how this plays out. They are already actively reallocating their wealth to prepare for this exact convergence of high debt and restricted capital. Markets are aggressively tracking a few specific signals: consistently cooling inflation data, any hint of potential rate cuts from the Federal Reserve, and the ongoing resilience of corporate earnings. Navigating the economy of 2026 and beyond will demand difficult, intentional choices. It requires careful decisions regarding tax policy, spending limits, and the fostering of innovation. The most profound economic transitions rarely announce themselves. They begin invisibly, quietly reshaping the foundational bedrock long before the public notices. Every powerful economy faces challenges. The question is not whether problems exist. The question is how they are managed. America has faced financial challenges before and adapted through innovation, policy changes, and economic growth.